All right, it's 5:31 Denver time, so we'll go ahead and get started. Thank you all for joining us this evening for this evening's CattleFax Trends Plus Cow-Calf webinar. We'd like to start off by thanking Elanco for their continued sponsorship of this presentation and this program. I've been a sponsor of this for quite some time now, and I really appreciate their willingness to support this and make it free for all cow-calf producers to participate. So to get started with the presentation overview of what we're going to talk about this evening, first of all, we'll start in taking a look at the grain and feedstuff outlook, and obviously touch on drought and the implications there. Spend a good bulk of the discussion talking about the cattle market outlook, where we're at and where we expect the industry and the markets to move here for the remainder of this year, and taking an early look into 2022. And then we'll have a discussion taking a look at pasture, rangeland, and forage insurance. And then lastly, hear from Dr. Mark Hilton from Elanco Animal Health. So I'm Patrick Linnell, analyst here at CattleFax, and I'll take us through the first portion of this discussion. So as we look back, over our shoulder and from a 30,000-foot view of where we're at in terms of the cattle markets, we all know that these are that commodity markets in general tend to be pretty cyclical in nature, and the cattle market's no different. Prices and supplies, tend to make about a 10-year pattern, is what we see from high to high or from low to low over the course of history. As we look back, where we're at, 2021 or 2020 was what we would call the cycle low in terms of price, or would have been the cycle high in terms of harvest numbers, and that's even pre-COVID. If you take the pandemic out of the equation, we still would have believed that 2020, would have been the low in price for this portion of the cattle cycle. Obviously, things were adjusted quite a bit lower in terms of price because of the pandemic, but nonetheless, as we look going forward, you can see the rough expectation on what this means. In terms of prices, as we look going forward, prices should begin to trend higher as a result of harvest levels that are starting to decline. But I think looking at the blue line represents the beef cow inventory. We liquidated cows last year. We probably would have liquidated cows this year even without drought. And now, because of this drought situation that's hitting the north and western portions of the country, there's probably another year of liquidation here in front of us, just due to decisions that will be made this fall. So as we look going forward, essentially a few more years of some cow herd liquidation here in front of us. Fed cattle supplies starting to trend lower, and ultimately prices beginning to trend higher. As we look at where we're at in terms of profitability, we've obviously come through a period here where margins have been quite a bit slimmer, across the industry, but for the cow-calf segment in particular, costs really haven't improved, while prices have certainly been soft. As we look forward, though, this chart looks at profitability across the industry, from the cow-calf producer, stocker, fed cattle, up to the packing segment. And so you can see that, obviously the packing segment has commanded the largest share of the profit margin in this industry over the last couple of years, as we've simply had more bodies in terms of cattle supplies than we have shackle space. And so as we look going forward, though, we look towards a much more even distribution of those profit margins as cattle supplies start to tighten, and the producer segments of the industry begin to capture a larger portion, of that dollar. And I think an important thing to note here is where we've been over the last roughly 2 decades in terms of profitability. Across the 4 segments, we've averaged $249 of profit, $259 over the last 20 years. Compare that to 80s and 90s, $32 ahead across the 4 segments. Now, what this means is the cow-calf, the producer levels have obviously not gotten the share of the profit margin that we would have all liked to have seen over the last several years, but the margin has been in the system compared to the 80s and 90s when there was no margin across the system. So as we look going forward, taking a macro level look at beef cow inventories and beef production. So we have started to move cattle inventories lower over the last few years. However, beef production has remained at or near record levels. Simply due to, again, because of the pandemic, you have packing plants shut down, weren't able to get cattle harvested, so fed cattle supplies were backlogged, the feeder supply was backlogged. As a result, we've kept beef production plenty large. As we look going forward, that should begin to trend lower, which should support values across the chain. So flipping the script a little bit and taking a look at the drought and feed grain landscape before we get started more specifically to cattle. So this is looking at the U.S. Drought Monitor. And I think this is something that isn't shocking or surprising to many of us, especially in many of these painted regions that we see on the map through the North Plains and then on into the western portion of the country. Obviously, some pretty significant drought that we're seeing here for producers in those areas. Now, there's been plenty of comparisons to the last major drought that we saw, in 2011, 12, and on into 13. But I think the important thing to note here is, as you look towards where this drought has occurred, plenty of areas in the South Plains were in a little bit rougher shape as we worked through last year and early this year. However, conditions have improved dramatically, and you can't sell short how many cattle or what portion of the nation's cow herd is in many of those areas. And so this looks exactly at that. So using the Drought Monitor index and applying, what percentage of the nation's cow herd is in a moderate or worse drought. So obviously by land mass, the West and North Plains covers a pretty significant stretch of territory and country. However, it's nearly 50% of the nation's cow herd that's in the Central Plains, and much of that area, has been spared of drought, in particular central and south from there. So as we look at this number, roughly 30% of the beef cow herd is in drought conditions as of July. Now again, compare that back to 11, 12, 13. We had a solid 40% and at times up to 60, 70. At one point, 80% of the nation's cow herd in drought. So while we will certainly can expect to see some liquidation in those areas impacted by drought today, as producers face some pretty rough conditions there. From a national level, the liquidation due to the drought factor at this point shouldn't be nearly as severe in terms of the U.S. beef cow herd liquidation. Now, with so many of those areas impacted by drought, we're also clearly seeing an impact in hay prices. And this looks at the U.S. average hay prices, all hay. Obviously, very few people buy hay at a U.S. average price, with some pretty significant differences by region. But as you look at where these prices have moved, pretty high for this time of year, when we should be, have plenty of new hay around us, and prices should starting to be softening seasonally. Instead, prices have pushed higher, with prices well into the $200 a ton mark, for many areas of the country. Now, looking at the other side of the more the feed grain landscape, corn prices, it's no secret, have also moved sharply higher over the last year. As we moved through this time last year, we began to see tighter stocks to use, with some decreased production estimates, and then we saw large exports of corn, in particular to China over the last year. And so as a result, stocks to use tightened significantly, and prices represented in the red here clearly surged higher. And so the short message here is that as we look at it, the feed grain landscape, we'd spent a lot of time in a 425 to 325 range for over 5 years. Now we expect prices will obviously will not return to that level, likely anytime soon, or potentially ever when you think of longer term trends and just slow increases to commodity prices. And so as a result, we don't know exactly where this will settle, but we can expect that as we look going forward, expect higher feed grain prices across the board. So looking at higher feed grain prices or higher feed prices for grains, as well as for hay, as we previously looked at. So taking a closer look at the cattle supply. So as we've mentioned, several years of beef cow herd liquidation. And you can see that as we have forecast, expect that what the USDA will tell us on the coming January 1 is another 1.3% decline in the beef cow herd, and then likely this decisions on heifer retention happening this fall, in particular due to the drought, will result in another decline on into 2023. And then likely as we get into the middle portion of the decade, start to turn that trend higher. Now, as we look at beef production, it's important to remember that today's calf crop, this year's calf crop, is beef production 2 to 3 years from now, as we work those cattle on through the system. Now, again, from a cyclical standpoint, what we should have seen is 2020 should have been the high in beef production, as we saw numbers peak in terms of slaughter numbers. However, there was obviously a bottleneck at the packing level. And so what happened was that peak in beef production and fed slaughter moved from 2020 on into 2021. Now, as we look going forward, we should start to see those declines take place. Likely at some point here in the fourth quarter, start to see that trend significantly change, but it could be on into early next year. But again, as a whole, expect to see beef production down. We have it penciled down around 2.5% in 2022, which should be supportive to values. Now, another factor to the equation is the balance of trade. As we look at exports, exports did suffer a little bit in 2020, simply because plants were shut down, product wasn't being produced to be able to ship it. And as a result, we did see an increase in imports to try to balance out that supply, in particular for lean grinds. As we look forward this year, we've seen that balance of trade flip pretty substantially. Exports running record large for many months. I believe the May number was the largest month ever on record for beef exports. And meanwhile, imports have resumed a more normal pace, sitting around that 3 billion pounds mark on an annualized basis. And looking forward, we expect that that trend should continue to move higher and support strong exports as the world continues to climb out of the pandemic. And over time, we see more and more consumers move into the global middle class and add more protein to their diets. China obviously presents plenty of upside potential, but as geopolitical things may occur, certainly it provides plenty of uncertainty, but we believe that, again, that continued growth of the global middle class be supportive to exports. And this takes a look just more closely at exports to the China region. And what we do here is we include Hong Kong, Vietnam, and Taiwan as well, knowing that there has been historically plenty of gray channel trade of beef that's imported to those other countries, and then moves on, into China unmarked. Well, as you can see, even accounting for that, we've been at a pretty significant pace here this year. As China in particular continues to demand protein, and they've certainly suffered a huge hit to their own protein production due to ASF, African swine fever, wiping out around half of their hog herd. Well, in the process, they've acquired a taste for beef, and U.S. beef in particular, the high quality profile of the product that we produce. And so that taste has stuck around at this point and continues to command strong export demand for U.S. product. So as we look forward over the next several years, smaller beef production, continued favorable balance of trade means that per capita beef supplies, what's left on the U.S. market, should continue to trend lower over the next several years. Again, even 2020 would have been the peak in terms of net beef supplies, and even though we've produced more beef this year, that favorable balance of trade has offset it and resulted in slightly smaller supplies here today. As we look forward, we'll see both that continued strong export demand and smaller production. So we've looked at supply. Now to shift to the demand side of the equation. So as we take a broader look at the U.S. economy, there's certainly been a lot of swings and a lot of factors impacting the consumers over the last several years, or over the last roughly year and a half. So the top chart takes a look at consumer spending versus the savings rate. And so you can see in the red line, spending as a percentage of income took a significant hit during spring in particular last year, but has remained depressed. And so as a result, the consumer's not spending it, so they're saving it. They're adding it to the green line. And as we look going forward, this has clearly set the consumer that the U.S. population that's been able to maintain a job, stay employed throughout the pandemic, has remained in a pretty healthy spot and will be in a healthy spot as we look going forward. And you certainly don't want to fade the U.S. consumer in terms of demand when they have money in their pockets. So from a broad perspective, demand should continue to remain strong as we look going forward. But simply as the consumer is in a pretty healthy situation. Now the bottom chart looks at government transfer payments. So whether it's Social Security, unemployment insurance, and then also the stimulus checks that many Americans received again over the last year and a half. And as you look at what percentage of that compose their income, huge percentage over the last year. And many of the Americans, again, that have either been receiving unemployment insurance or have maintained jobs, received this money and stuck it in savings. So the consumer, again, is sitting on, arguably a healthier financial situation on average than they've been in for quite some time due to the amount of money that the government's thrown at the consumer. And we've seen the impact of that in terms of beef demand. This is the annual Consumer Beef Demand Index. As you see, we put in a new high in the midst of a pandemic last year. 134 index, the highest on record, and we're well on pace to set a new record and beat that out again this year based on our expectations for supplies and retail prices for beef. Again, the consumer continues to show their willingness to spend money on our product. The next year, we do expect to see a softening in that as we do see supply chains get back closer to an equilibrium. But even so, with our forecast, letting demand relax down a little bit and return to somewhat more normal levels, still affords for a healthy price level. As we look at the competition, this chart plots the percentage change in beef prices, pork, and broiler at the retail level since 2018. So just charting where these retail prices have gone, since pre-pandemic. And you can see beef prices obviously surging higher when retail shelves were wiped empty last spring, but breaking back, but still remaining pretty elevated and pushing higher here again this spring and summer. Now, meanwhile, pork and broiler prices have also seen a pretty significant move higher. So as you look at it from a consumer standpoint, beef is more expensive. However, if you want to feed your family meat protein, the other options are more expensive as well. And so compared to prior years when we'd show a chart similar to this, when pork and broiler prices were more depressed, there's no cheaper alternative here today. And as you compare your options between beef and pork or chicken, certainly the quality of beef affords us an advantage there. And an interesting story, breaking that down a little bit farther, this looks at a wholesale demand index and breaks it down by choice in the green and select on the red. And so important to note that a lot of this driving trend in terms of improving beef demand, it's all been led by the choice side, choice and higher product, choice, upper 2/3 choice, and prime beef. The consumer continues to spend more and more, place more and more value on that product as compared to select, essentially flat, a non-growth market, not necessarily trending lower, but certainly not showing the growth in demand like we've seen for the higher quality product. So as we take this closer to home in terms of the cattle market outlook. So first, taking a look at the composite box beef cutout. So as you look this year, in the process of setting a record high annual average for box beef values, with the Choice Select blended cutout at around $260 per hundredweight. As we look going forward, should continue to be supported by strong demand, at the retail level, and food service level by the U.S. consumer, and on top of global demand as well as just broader inflationary pressures as we look across the economy. Inflation has certainly been a factor that we've seen over the last several months. And so as general price levels across the spectrum move higher, will be supportive to beef as well. And then add on top of that, again, we're also looking at smaller supplies into 2022. So you have both the demand and the supply side of the equation affording firm prices. Now, as we mentioned, clearly slaughter capacity was one of the biggest challenges as we worked through the last year and continues to be so today. This chart looks, the blue bars outline what we estimate to be Monday through Friday packing capacity at fed cattle packing plants. And the red line is weekly average fed slaughter. And so you can see that over the last several years, we've slaughtered more cattle than there has been Monday through Friday capacity. And we've done that by running the plants consistently on Saturdays. And so as we look going forward, or as we look back over our shoulder at 2020, the widest gap that we'd seen on record was what we experienced. And that resulted in depressed cattle prices relative to wholesale beef values. And that continued challenge that we've seen with, again, continued large cattle supplies this year, and then labor challenges here in the short term, preventing the packing capacity or preventing the packing segment from slaughtering as much as they otherwise would have, has hampered packer demand for cattle here this year. As we look going forward, add in you have plenty of positive news in terms of expanded packing capacity throughout the country, and you can see how we're increasing that bar for packing capacity over the next several years in terms of our forecast. At the same time as fed cattle supplies, again, moving lower. So again, as we look at it, with the wholesale beef values being more supported, and then at the same time, this packing capacity utilization metric moving in our favor means that fed cattle prices and all cattle prices should be able to gain a higher percentage of that beef dollar. So taking a look at fed cattle price, we've continued to trend higher since the first of the year, but it's been a grind, slow and steady grind, as we've continued to just slowly chip away at those cattle supplies. As you look, we're on pace to average around 121 for this year. As we look forward to next year, we have a forecast of 135 per hundredweight on an annual average basis, with a range of 120 on the lower end and up to 150 on the upper end of the range. And expecting that, as we look going forward, prices should continue to trend higher as a general rule from now, roughly through the spring highs of next year. Can always be setbacks, but the supply situation should continue to trend slowly but surely in favor of higher cattle prices. And just looking at cattle on feed again, we've improved cattle on feed, chipped down, removed essentially 1 million head from its peak that we saw as of February, but still remains generally large historically. And so we'll begin to see a seasonal incline or increase here. But again, slowly and surely, working through these cattle supplies, get into a more comfortable situation. In terms of the feeder cattle supply, as of July 1, what the USDA reported in terms of feeder cattle and calves outside of feed yards and around the country, down around 600,000 head from year-ago levels as of July 1. And that's been reflected in feeder and calf prices. This looks at the CME feeder cattle index, so basis an 800-pound Central Plains feeder steer. You can see continued to move higher, and roughly nearly $20 higher, $15 to $20 higher than where they were at this time last year. Hitting that roughly 160 mark here today. As we look going forward, expect that as we look at these non-expansion type environments, again, where we're looking towards tighter cattle supplies, you tend to see a flatter market on average through the fourth quarter compared to if you look at the last 20 years rolling them all together. So what we're expecting here is the feeder prices have certainly achieved the seasonal rally that we hoped for and expected, but should likely more or less flatten out from here. Now, as we look towards next year, expect to add basically $20 per hundredweight to feeder prices, expecting a range of roughly 150 to 180. Now looking at steer prices, so these are steer calves for immediate delivery. We've seen them remain pretty stout here as well, with plenty of these calves for fall delivery that we've seen over the summer videos, pushing into the 80s north and roughly the 70s south. And so as we compare those prices to spot delivery, expect that as we work towards the heart of the fall run, prices could potentially soften, but we'd expect that we likely could see some pretty strong support there around that 170 mark, down into the mid 60s. Should be pretty strong support as we work through the fall run. Certainly pressure, but again, as we start looking towards these tighter cattle supplies, should remain supportive. Now, but certainly recognizing that there is risk that they could soften a little bit more yet due to drought-forced movement and high feed costs. But nonetheless, as you compare even the lower end of that range, or even into the mid to low 60s, compare that back to the fall run for the last 2 years, certainly a much improved situation there. Now, another thing to note, this spins back to the fed cattle level, and this looks at average fed cattle premiums. So those cattle that are marketed on a grid or formula basis, compared to what those cattle would bring in the negotiated cash market. And then it further breaks those prices down by cattle, pens of cattle grading over 80% choice, more moderate grading, 65 to 80% choice, 35 to 65, or lower grading cattle. And so continue to see large premiums in that over 80% choice, the higher grading buckets. Even as we've improved grade over the last several years, seen a lot of cattle in that pool. So as a result, brought up that average. And so this is all to say that we're seeing the spreads widen out in terms of differentiated value at the fed cattle level, and supporting the prices for higher quality cattle. And so, and we're seeing that those differentiated values continue to be passed back at the feeder cattle and calf level. And so continuing to see wide premiums and discounts for calves and cattle that are able to check those quality marks. And taking a quick look at cow prices, obviously as we work towards the fall run, we'll see cows being cold as well. Cow prices have remained extremely stout this summer, propped up by high lean, 90% lean values, on the beef complex, certainly propping up values. Now, expect that prices will move lower from what we've seen here over the summer months, always do, but expect again that prices even on the lower end of the range that we have drawn in here, well supported compared to recent years. And then lastly, just looking at our broader outlook over the next several years in terms of cattle prices, again, we believe that the cyclical lows in price were 2020. Prices this year have been somewhat restrained by continued large fed cattle supplies. As we look going forward, expect that prices for all classes of cattle should continue to trend higher on into the middle part of the decade. So that wraps up my portion of the discussion. I'll pass this over to Tanner A. Heron to continue the discussion.
All right, thanks, Patrick. Get my screen set up here. Before we get rolling, if you do have any questions, whether it's on Patrick's section, my section, or Dr. Hilton's here coming up, don't be afraid to type something in the question box or the chat box. We'll try to get to those at the end of the session here. And if we don't run out of time here tonight, we'll be sure to send you an email tomorrow with our answer. But we'll go ahead and dive right in. As Patrick said, my name's Tanner Ahearn. I'm going to walk through some of the pasture, rangeland, and forage insurance. You know, some people use the loose term or call it drought insurance. But I think to set the stage for that discussion, be ideal to kind of look at what the future holds based off of our weather outlook that's provided to us by Dr. Art Douglas. As we look at the fall temperature here in the Central Plains, pretty warm or warmer than average across the Central Plains, while the rest of the country is pretty much on the average mark, the long-term average, which runs from 1991 to 2020. As far as fall precip goes, do look to maybe get a little bit of relief in some of those real drought-stricken areas. When we think about the drought monitor that Patrick showed, you know, the northern plains, the areas around the Rocky Mountain region, and of course the Northwest is in some dire need of some relief. You know, honestly, probably not ideal time. Wish this would have come a few months earlier, but nonetheless, it does look like there is a chance for some precip over the next few months. As opposed to the Corn Belt regions, maybe a little bit drier than average, could help with harvest and improve that, or help with harvest conditions as we get deeper into the fall. As we move on into the winter, again, look to see colder than average temperatures through across most of the eastern 2/3 of the states, while the western half, especially the Southwest, will be average to maybe 1 or 2 degrees warmer than average. Winter precip, as we think about the main cattle feeding regions here across the Central Plains, does look like it's going to be a little bit drier than average, maybe more of an open winter, which is always favorable for cattle feeding conditions. At the same time, when you think about some of the wheat pastures, maybe it will pull them back a little bit. But again, if you think back to the drought monitor, they're in very good condition as far as the southern plains go, and where you'd see a lot of your wheat pasture winter grazing. Unfortunately, winter precip outlook for most of the western half of the U.S. Does look to have a little bit of drier conditions, drier than average as we get into winter. You know, as we think about just the overall landscape of the weather condition, the weather patterns we've been in. Currently, we're in a La Nina weather pattern, which is typically not favorable for a lot of your cattle grazing regions, as we saw there on the drought monitor. It does look like the La Nina weather pattern will intensify into the fall and continue through the winter. We'll see how the spring plays out as we run more models, or as Dr. Douglas runs more models to see what the spring forecast looks like. But it does appear the La Nina weather pattern is here to stay, at least into the winter time frame. So we're changing things up a little bit on this webinar, just a little bit more of a educational, or give you guys some ideas as far as what's out there to think about as cow-calf producers. Some of you may be very familiar with this insurance program that's offered by the USDA's Risk Management Agency. Some of you may have heard about it. Some of you may not have a clue. Either way, just I think a nice refresher, or at least inform you about what's out there. This insurance program is offered in all 48 states across the continental U.S. It's important to understand that this insurance program only protects against one thing, and that's rainfall compared to the long-term average. Basically, it does not consider account for any production loss, any production data. If your hay field or your hay production falls significantly one year, this does not cover that. It simply looks at rainfall amount. It's important to note that it is not based off of counties, but off of a grid system. So if you operate in one county, you may be have several different grids within that county. Just definitely need to keep that in mind. The rainfall measurement and how it's calculated, what we're comparing against, is collected by the NOAA Climate Prediction Center. And the way they do that is they have 4 weather stations around every grid. It's collecting and reporting the rainfall every day. In theory, the 4 weather stations supposed to be the closest weather stations to that specific grid. The thing with that, because they are using different weather stations, you may not have all 4 in the same grid. You likely won't have all 4 in the same grid. Because of that, the measurement that's collected on the 4 weather stations may not match the amount of precip that you as a producer measure within your grid or within your county. It should be close within the ballpark, but it will likely not be identical. And what we're measuring against is a long-term average from 1948 to present. Typically, it takes a couple years before they get the data collected and added to the long-term average. But I think it's encouraging to see that the long-term average goes all the way back to 1948, 70 plus years. Because if we think about what's gone on in the last decade, there's been some huge fluctuations in droughts and the amount of precip we've received. So you're not going to have just 1 or 2 or 3 years significantly affect the long-term average because we're throwing in 70 years worth of data. Now, if you are interested in this program, the way it works is the USDA breaks the policy, or you insure different intervals, 2-month intervals. So you can see them all listed out here: January and February, February and March, March, April, and so on. And to do this, you would select a minimum of 2 intervals, but you cannot overlap. So you could not choose January and February and then choose February, March. Basically, you can't double dip on the month of February. So you'd have to choose a minimum of 2 intervals and a maximum of 6 intervals. Because you can't double dip, you basically have to go every other interval throughout the year to get the 6 intervals. And the reason you have to select a minimum of 2, because in most regions, you can only put about 60% of your premium or policy essentially per interval. So you have to do another 40% in a different interval, or you can split it up. I mean, you can do all kinds of different variations as far as the percent of your value, but nonetheless, you have to equal 100%. It's important to understand that each interval rainfall measurement is independent of the rest. So if, let's say, you have insure January and February and March and April, you may collect on your policy in January and February, but may not collect on March and April. And as you think about the intervals, as far as using this policy or this insurance program as a risk management tool, the interval component of this whole policy is probably one of the most, if not the most important part. If you think about some of your regions, and as you think about the timing of what time of the year you want to insure, let's say July, August, your average rainfall is, basically nothing. Why would you want to insure those 2 months if you're trying to beat the long-term average of basically nothing? So think about some of the seasonality of your rainfall. What time periods do you have adequate rainfall typically? What time periods are important for grazing production or hay production to produce that crop, and then insure against those possibilities. I mean, there's all kinds of variations, but this is definitely an important key to this program that's out there. So a big benefit to this policy or this insurance program is that it is subsidized, and you get and it's based off of your different coverage levels, or what they call trigger levels. So if you cover 70 to 75% of the average rainfall, you're subsidized by 59% for your premium. 80 to 85% coverage equals 55% subsidized. The maximum coverage level that you can do for average rainfall is 90%, and then you get subsidized 51% on your premium. So you have a range of 70 to 90% coverage. They also have what they call the productivity factor, which ranges from 60% to 150%. This is really up to you as a producer to choose what level you want to do here. And the way it works, it's basically an adjustment factor to each county's base value or price for the different for the premiums that are out there, and the potential indemnities that you could receive. So if you're wanting to pay a little bit higher premium with hopes of having a bigger payout potentially, you would increase your productivity factor. On the flip side, if you want to pay a little less premium, decrease your productivity factor. And it's really up to the producer to decide where they want to fall there. So the way we measure the rainfall, it's all index based. So essentially your long-term average going back to 1948 is 100 or 100%. Your final grid index value is what is measured in each grid by those 4 different weather stations. If you fall below 100, it means that your rainfall was below the long-term average. If you measure above 100, then obviously your average precip during those 2-month intervals was above the long-term average, and you would not collect on the policy. So just to give you a quick example to kind of tie everything together, let's say your trigger level or your coverage level was 85%. So if your final grid index, or the amount of rainfall that you receive, is 75% of the long-term average, which would be 100, then you would collect your indemnity. So on the other hand, if your final grid index, let's say, was 90%, you would not collect on your policy. Even though your measurement fell below the long-term average because your coverage level was 85% or less, you would not collect. And then just the final slide here, things to consider and keep in mind as you possibly think about this program. You know, I look at it as just another risk management tool in your toolbox. The weather patterns are pretty hard to predict. It's just something to be ahead of the game, be a little bit proactive. If you do want to look into this program, enrollment begins in September of every year as they get all the data collected and finalized for the upcoming year. The sales close the middle of November, November 15th. Another nice thing about this program is you do not have to pay the premium up front. You can wait until after the intervals that you choose. And it's important that you do work with an insurance agent or someone familiar with this program. There's also a lot of tools out there that allow you to kind of analyze, see some of the historical data when you look at your specific grids, your specific regions, what are some of the long-term average. But if you are going to do that, there's some tools on the USDA's website. If you're interested, I can provide that to you, or a lot of your different insurance companies have that as well. And you'd be working with basically a crop insurance agent or someone like that, or someone that focuses on maybe LRP insurance. A lot of times those agents do both of these or multiple programs. But as a producer, as you think about engaging in this program, participating in this program, some things to consider is how much are you willing to pay per acre or per head? You know, you can because of that adjustment factor, you can pay quite a bit or you can pay minimal amounts on your premium. Obviously, there's some give and take there. You wouldn't, if you do collect on the policy, wouldn't be as big if you have a lower productivity factor. But as you think about your bottom line and some of your costs out there, it probably wouldn't hurt to have an idea or a dollar figure as far as what you'd be willing to pay for this policy. So with that kind of just gives you the highlights on that program. I'll switch over the controls to Dr. Mark Hilton from Elanco to walk through his section, and always glad to hear what the Elanco representatives have to share, and again, greatly appreciate their support. So, Dr. Hilton,
thank you, Tanner.
Should be the presenter now.
Okay, and let me know, are you seeing the correct format of my slides, or are you not?
No, we're seeing your note slide, so you need to switch.
Gotcha. Switch which one that is. Technology isn't my best friend, so
I think if you go to display
see what
settings,
happens.
you may be able to swap. Or you should be able to change screens through the GoToWebinar.
Yeah.
Share
When I first saw that, it didn't give me that option on the thing. So let me see. So you're still seeing the wrong.
Right now, we're seeing your home screen.
You're seeing where it says economic cost of bovine, but you're seeing the notes section.
We were before. Now we're seeing your home screen with your.
Oh, my family.
There we go. There we go.
Sorry about that. Yeah.
No, you're good.
That's perfect. An old picture. We've added to the grandchild pool since then. We're up to 7 now. So hey, thank you, Patrick and Tanner. I appreciate it. These are always fun to do, and Elanco's glad to sponsor those. So I'm going to give you a little bit on economic cost of bovine respiratory disease, because golly, we're getting ready to wean calves and background them, and we just don't want to have some problems. So, you know, one of the things I'm going to say is work with your herd health veterinarian. That's the expert on your farm or ranch. That's the person that's going to be able to help you the most on this thing. So this is me. I'm a Purdue guy, bachelor's and DVM from there. I practiced in Iowa for 15 years. I was a professor at Purdue for 18 years, and I've been on the Elanco team for 5.5 years now. So I've been in the cow-calf segment of veterinary medicine for my whole 38-year career. I really love that part of the industry. So when you think of Elanco, I hope you think of innovation. I hope that you think we're a company that's out there trying to make things better for the beef producers, and Rumensin's our flagship. Gosh, you know, it's out there in the feedlot. About 90% of all feedlot cattle get fed Rumensin. Back in '88, we approved it for beef cows, and boy, this year with the drought in so much of the United States, feeding a couple 100 milligrams, 200 milligrams of Rumensin will save your producers about 10% on their hay costs for the winter. So that's an innovation. Microtill, you know, you talk to feedlot veterinarians, backgrounders, and they tell you, hey, this product changed our life. It's been around for a long time, but really the first long-acting antibiotic that we could use on calves to get multiple days of therapy and metaphylaxis. That's where this product really hit its stride, taking those high-risk calves and using it. That safety syringe that's sitting there, gosh, those things are slick. If you have not used one, talk to your Elanco sales rep, talk to your veterinarian, and check one of them out. They're just a really nice piece. Experior, if I took a poll, I bet most of you have not heard of this. This is a brand new product that Elanco just launched, and it's the first product for livestock that has an environmental claim. So it actually takes the nitrogen that's being produced in the urine and retains more of that in the body for use by the body. So we've got less ammonia gas produced. So we're pretty excited about this product. Again, an innovation. So beef calves, let's talk about bovine respiratory disease. $800 to $900 million annually it costs, hurts your average daily gain. labor resources, treatment, retreatment costs. It's a big deal. I got to actually go back to Purdue and lecture to the vet students today, and really talk to them about bovine respiratory disease. I said, we've been talking about it for years. It's still a concern. So what's it do? Average daily gain over these 7 or 8 trials, 0.2 of a pound a day. So if you're feeding calves for 100 days, that's 20 pounds. 150 days, that's 30 pounds. Of live weight. Here's a carcass weight on a number of other trials. 11 pounds of carcass weight you're losing if a calf's just treated one time for bovine respiratory disease. So not one that's a chronic or anything like that. Just one single treatment on the thing. This was a study that was done that gets cited all the time. It was a real surprise to the researchers that showed that 65%, so more than half the cattle that did not get treated for respiratory disease had lung lesions. 68% of those had lung lesions. And just those lesions were, again, almost 0.2 of a pound in average daily gain that was lost. So prevention, prevention, prevention. We want to prevent bovine respiratory disease. And we don't want you to have to use any of our anti-infective products. We hope you don't have to buy Increxa, our new tulathromycin, Mycotil, Polotil that you put in the feed that is tilmycosin in the feed, Baytril 100, Loncore, our new fluorophenocal product, or Zelnate, the immunostimulant. We hope you don't have to buy any of those products from us, because we want you to buy these products, the vaccines. The price premium, both of you guys talked about dollars and cents. That's what CattleFax is all about. Patrick, really mentioned, hey, 2023 is going to be better, 2024 is going to be better, 2025. We're looking at some pretty good prices this fall. Prices are significantly higher than last year. And the feedlots are paying very nicely for calves that are preconditioned, have been pre-weaned, have been vaccinated. So that's where we want producers to spend their money. I look at a vaccine as an investment, whereas an antibiotic is a cost. It's something we don't want to have to spend. Nuplura PH is just a wonderful Mannheimia, a Pasturilla, if you'll say, vaccination. We've tested it against another Pasturilla vaccine out there on the market, and lots of these Mannheimia or Pasturilla vaccines, whichever term you want to use, have lots of endotoxin in them, which is a byproduct of making the products. It's the extracellular particles that are in that vaccine that we really don't need. It just makes the calves look a little dumpy, makes them feel tough. But Nuplura, when we did a research study, showed that it had 35 times less endotoxin, so 97% less endotoxin than another very good product that's on the market. So we are really high on Nuplura PH. It's the newest innovation in how vaccines are made. They actually take just pieces of the actual bacteria that confer immunity and use those to make the vaccine, and throw away all the stuff that we don't need. If you want to look, there's a couple-minute long video on YouTube. If you put in Nuplura PH on YouTube, it'll come right up, and it's pretty neat how it's made. Just this year, we launched Nuplura PH Plus. We have Nuplura PH Plus 3, which would be IBR, BVD types 1 and 2, and we have Nuplura PH Plus BVD, so it doesn't have the IBR. And we think these can really fit into a preconditioning vaccination program for your calves this fall as you're weaning. So really easy on calves as far as the Nuplura. The viral parts of this come from our titanium line, which has great research to show the effectiveness and to show how easy it is on calves. We've got lots of studies on intake, on fever, on sweats. Titanium super easy on calves. I've actually used the vaccine for 20 years. I switched our clients when I was an ambulatory veterinarian at Purdue and started using it on our herds, and got unsolicited compliments on how well the vaccine worked and how easy it was on the calves. So the Nuplura and the titanium line are wonderful for these weaned calves. ViroShield's our inactivated product, and we really think that really fits on the cow side a lot better than on the calf side. really good research that came out of South Dakota and North Dakota that showed increased conception rate when you used virus shield instead of a modified live pre-breeding. So we're really strong on lifetime immunity at Elanco. We want that animal to have lifetime immunity, and we think coming in with a product like titanium or nuclear pH3 early in their life, getting that modified live, couple doses early, and then once that animal becomes a breeding animal, then we switch to virus shield so that we get the protection and the safety of that product. So we think we've got a real nice portfolio here. So I didn't want to take a lot of time because I wanted to see if there was any questions. Elanco's here to help you on your cattle operation. We want to be an asset to you, our veterinarians, our sales reps, and Warrior Herd Health veterinarian is really super important to your herd. So Tanner or Patrick, if we have any questions, I'm glad to take them.
Okay. Thank you, Dr. Hilton, and again, appreciate Elanco's sponsorship. They've been doing it for several years for these webinars, and great overview of the products they have, both those that have been around for a long time, and I think it's encouraging and really exciting to see some of the new products that they're bringing out. That's pretty awesome for the industry, and again, appreciate Dr. Hilton joining us. We do have one question. Patrick, you covered the grain segment. Someone asked to clarify or touch on our price forecast for the corn markets. Would you like to answer that or elaborate on what our price forecast is for the corn markets?
Yeah, no, good question. Yeah, as we look towards our 2021 average, we expect that spot corn futures should average around 575. With the highs likely behind us. The way we see it is we're still anticipating that yield might be a little bit better than what the USDA is currently estimating. So we expect more of a range-bound, possibly softer market on into harvest. And then as we look towards 2022, what we have penciled in for next year is a 535 average, again for spot corn futures, with a range of 475 to 6.25.
Thanks, Patrick. And looks like we're running short on time, or got you guys sticking around longer than we had scheduled. But if you do have any more questions that you'd like to ask myself or Patrick or even Dr. Hilton, don't be afraid to send myself or Patrick an email. It's taheron@cattlefax.com orplinnell@cattlefax.com, and we'd be glad to help you out there. One other thing that we have an event coming up on the CattleFax side of things. We have our annual Outlook and Strategy seminar scheduled for November 30th. This is going to be both a in-person session or virtual option. In person will be out here in Denver. We'd be happy to have you join us. You could also have the virtual option. If you want more info on that, go to our website or send myself or Patrick an email. I'll be glad to get you set up there. It's just an outlook for the next 12 plus months, and we hear from different industry experts from all across the ag and economy. As well as last thing, we will have a recording of this webinar sent out via email tomorrow. It'll also be on our website for about a month or so that you can access at your pleasure to review any of the content. But just appreciate everyone joining us this evening, and look forward to having us join us again at the next one. Likely the end of January is when we'll have another one of these webinars. So thanks again, and have a great evening.